4, 3, 2, 1. Welcome, everybody. It's Walter here, and we're going to talk about some naked trading. How's everyone going today? Just curious to see how. Hello. Excellent. Hey. Welcome. Cool. Okay, so I'd like to know what sort of markets you guys would like to look at, because basically what we want to do here is use the markets that you are trading. So I don't really want to do anything other than what makes sense to you. So if that helps, if you could just type in the markets that you would like to see as examples, I will be able to start those for you. So just type into the box, into the chat box, the market and the time frame that you want to look at, and we'll use that. Okay. All right. Okay. Yeah. I know there's a bit of a delay, so I'll wait until your answers come through, and then we'll switch to the charts that you want to see. We're going to talk about swing trading, and I'm going to show you a simple way that, especially if you have a job, it's actually ideal, how you can use these simple setups in your everyday trading. And you can add it to what, it's really good if you only want to spend 15, 20 minutes a day analyzing the charts. But if you have more time, you could certainly add more time frames to your tool chest. All right. Kiwi, Aussie, pound, yen. Okay, great. Okay, let's do it. All right. So these are we're going to use 3 separate swing points. So we'll first go to the Aussie, which is right here. All right. This is the Aussie. Okay. What I'm going to do is I'm going to peel off all of the objects on the chart, because I like my charts clean. I don't like to use indicators. I just use horizontal support and resistance mostly, with occasional trend lines or things like that. Now, the type of setup that is ideal here is going to be when you get this kind of swing trade, and then you also have something else at its back. And what I mean by that is, typically I'm looking at horizontal support and resistance. So I'll show you how I draw it. So let's say we're going to trade the 1 hour Aussie chart. Okay, we'll use the 1 hour Aussie chart as an example. So this is what I would do. I would go to the 4 hour chart, and on the 4 hour chart, I would switch to the line chart. Now you'll see on your screen the line chart's going to populate, and you're going to see this blue squiggly line, right? Now all that really is it's a 1 period moving average on the close. And then what I'm looking for are those places where the market congregates. So the support and resistance zones that I look for are ones like here, the one at 75.10, where you see there was resistance there, and then there was support right here. Now what I'm trying to do is I'm trying to line up these patterns, these 3 patterns that I'm going to show you, which some of them might sound familiar, but I think what you'll find is that my rules are slightly more restrictive than a lot of other traders, and I find that this helps me with my win rate. And I would encourage you to test these on your own. There's really there's no reason why you should take what I say as gospel. Instead, I find that the successful students that I know, they spend a lot of time testing these things in Forex Tester. In fact, I can probably say that of all the students I have, the most profitable and consistent traders all use Forex Tester. There's really no exception. And that's because I hang out with a lot of discretionary traders. I'm sure that if you were some sort of robotic EA master, maybe you wouldn't necessarily have to use Forex Tester. Maybe you would use something else like Strategy Tester or whatever. But I've found that historically the best traders have that practice. Okay, so this is what I would do. I would draw these zones in like I'm doing right now, and you can obviously see the support and resistance. So I'm doing this on the 4-hour chart because I want to trade the 1-hour chart. So that's really what I'm looking for here, are these places where the market has repeatedly bounced. And then I'm going to drop down to the 1-hour chart, and I'm going to go to the candlestick look. All right. Now, what you'll notice, I'll zoom in here so you can see it. What you'll notice is that actually we have one right now. Now, I wouldn't necessarily call this a good one, but this is a bearish big shadow. And there's a couple of reasons why it doesn't fit my criteria. Number one, it's not big enough. Okay, so let me write down. I'm going to write down all the rules for these swing points. Now, again, what I'm looking for are two different factors to come into play. One is that the market prints a repeatable, testable pattern that I found in my testing that works. And two is that it prints this pattern on a reliable support and resistance zone. So I first identify the support and resistance zones, and then after that, I wait for the patterns to happen there. Most of the time when the market gets to these zones, it doesn't give you a pattern. Or it's a little bit ambiguous, but occasionally you will get a pattern that suggests that there is a trade. And that's what we're going to talk about today. We're going to talk about the 3 patterns that I believe are extremely useful. Now, if you have a job and you don't want to sit in front of the charts for 5 hours a day, you probably would want to stick to the daily or weekly charts, or perhaps the 8-hour charts. 8-hour charts are also doable, or 12-hour or 48-hour. You can mix and match and create your own charts. But basically, what I want to see here is a pattern. When I'm talking about the big shadows, a pattern kind of like this one, or really the best example, or a slightly better example, would be this one. Now let's explain and talk about what these are. A big shadow has the following criteria, okay? 1, it has a higher high and lower low than the previous candle. So it's got to have a higher high and a lower low than the previous candle. Now you'll see that the 2 candles I've identified here, the one that just printed a couple hours ago on the Aussie, this one indeed has a higher high and it does have a lower low. And then this one over here that I've also identified previously, this one has a higher high and a lower low. Now, the second criteria is a little bit tricky, and some people wonder, why is this the case? Well, what I'm looking for with these, and you'll notice that these rules are what differentiate this pattern from what a lot of people call an engulfing bar or engulfing candle. The reason why these are not all big shadows or engulfing candles is because the big shadow has additional criteria that don't fit the standard engulfing candle pattern, okay? So number 2 is that the close is near the low. That's for bearish big shadows, right? Obviously for bullish, it's the opposite. The close would be near the high. So the close of the previous candle, or sorry, the close of the current candle is near the low, okay? And in both cases, that's the case. Now, this one is a little bit tricky because there is a little bit of room, but still, this candle is 50 pips, and the close is within 13 pips of the low. So that's pretty good. Ideally, it would have been a little bit closer, maybe within 10 pips of the low, but that's still okay. It's okay, right? Excuse me, just having a sip of my coffee here. All right, number 3. There's room to the left. What is room to the left? What are you talking about, room to the left? Well, the reason why this room to the left rule is so critical is because we're looking at swing points. And we don't really know when the market is going to print a swing point or not. But what we do notice, if you go through the charts, is that a lot of these swing points, that is a spot where the market bounces and doesn't come back there for a long time, they have what we call room to the left, or space. And that's where the 2 candle formation prints on a unique area of the chart that it hasn't really printed for a long time. And you can see that I've extended this box to the left of this little swing low down here. This is what I'm talking about. This much of the candle printed on an area of the chart that hadn't really had any price action for a long, long time. In fact, you can see the last time the price action was down here was January 20th. Now that may not seem like a long time ago, but remember we're talking about 1 hour chart. So that was 70 candles ago. 70 candles ago, the market printed at that area. So room to the left simply means that the market has printed this 2 candle pattern, this big shadow pattern, at an area on the chart where we don't see recent price action to the left. So you'll see that this candle right here that has the arrow that I'm going to turn black. So this candle with the black arrow, this is a higher high and a lower low. It has a close down near the low. It completely engulfs the prior candle, but there isn't really any room to the left, okay? And that's not ideal. That's why this one's not a very good one. There's actually one other reason why it doesn't fit all criteria, but obviously number 4 is that the second candle engulfs the first, which is really what number 1 says. So it completely engulfs the prior candle, which is what number 1, this rule right here, higher high and lower low, is by definition means that it engulfs the prior candle. Now, I want to talk about one more rule here, which is it's the largest candle of the previous 6. Largest candle of the previous 6. Now, you might say the previous 5, the previous 10, the previous 20. But really what we want to see here is a wide range. We want to show that there's some volume, some strength, some real impressive push behind this move. Now, this candle is only 13 pips. And in fact, it's not the largest candle of the last 6 because this candle right here, I think, is a little bit bigger. And that's 1, 2, 3, 4, 5 candles ago. So this isn't the largest candle of the last 6, and it doesn't have room to the left. Now, when do I enter these trades? I like to enter when the next candle trades lower than the low. Again, this is for the bearish setup. Enter on a breach of the low. That's for bearish setup. So if you're talking about a bullish setup, then you'd enter on a breach of the high. Are there any? Let me know if there are any questions about this. Does this make sense what we're talking about here? So if we compare this candle right here, which is the one with the black arrow, and we compare that to this candle right here with the pink arrow, you'll see that the candle with the pink arrow is the largest candle, has the widest range of the last 6 candles by far. It's not even close. In fact, I think it's the largest candle on this chart. Yes, it is. So there really aren't any candles to the left of this that we can see anyway that are bigger. So that's a really good sign. The close is near the low. It could be a little bit closer to the low. There's a little bit of room to the left. There's not much. And one of the reasons why that's the case here is because this is kind of it's almost like a double top formation. Now, I'll tell you what would have made this one even better. See, it only has this much room to the left. Very, very little room. It goes back to this previous touch right here. What would have made this bearish candle even better, the one with the pink arrow, is if we had a higher high. If the wick was a little bit higher, because then we might have some room to the left because we might be able to do something like this and extend that area where the candle printed all the way over to this candle over here, right? So that would make this one slightly better. But otherwise, this one with the pink arrow, this one fits everything we're looking for. It's a higher high and a lower low. The close is near the low. There's room, a little bit of room to the left. Really, there's not much room because it's got that double top sort of look to it. And it's the largest candle of the last 6. Now, in both cases, the very next candle does trade lower than the low, right? So the candle that's identified here with the black arrow, the next candle does trade lower, so that's where the trade would be triggered. The sell stop would be triggered below the low. My stop loss goes up above the high. Now, profits will be taken where? Well, I like support and resistance. So in this case, you might be looking for 17 pips down here, where you might see the market, see these little wicks down here. The market might find some support here. Otherwise, you could go all the way down here to this low. That would be about 30 pips down to that low. And so the risk on this would be 13 to 15 pips. And the reward would be either, if you went to this spot, you'd be looking at about 1 to 1. Otherwise, you might be looking for, about 25 pips or so, which is, about 2 to 1, roughly. Yeah. Does that make sense? Everyone cool with that? Yep. Okay. All right. All right, cool. So we could probably look at some bullish examples too. So you can see kind of the other side of it. So, and obviously you want to see it on a zone, right? So I didn't mention this, but the sixth rule would be that this happens on a zone. So at a resistance zone for a bearish candle, 2 candle pattern, prints on a resistance zone. Okay. Now again, that's where this one with the black arrow isn't really ideal because it's actually on support, isn't it? It's on top of the 75.66 support resistance level. So that's not really ideal. But this one over here is actually much better because it's on resistance. It actually wicks into the resistance. Okay. Cool. All right, so let's keep going. Let's look for some bullish examples. This one over here, can anyone tell me what's wrong with this one? I'm going to take a sip of my coffee. I'll wait for you to answer. But this bullish setup here, what would be the reason why that one might not be ideal? What's the issue with this one? Any ideas? There's a couple of issues that I can see, and I'm just curious if you can see them as well. What would be that issue? Zone, yeah. It's not on a zone. It's between the 75.10 and the 74.27 zones that I've drawn on my chart. What else? What about the next candle? What does the next candle look like after that bullish big shadow candle? And good day, Antonio. Welcome. Good morning in South Africa. It's actually Australia Day here in Australia, and it's kind of like, it's not really Independence Day, is it? Because Australia's still under the Queen, but it's kind of like 4th of July in the US or whatever, sort of. Yeah. So the candle over here, the reason why this one wouldn't qualify is because this red candle after doesn't trade higher. So what I typically will do is I'll put a buy stop for this bullish setup up here, a few pips above the high, and you can see that it didn't trigger on the very next candle. So but I typically will wait 2. So if it doesn't trigger in 2 candles, then I kind of scrap it. Yeah, it never really triggered the buy stop, but it did on the next candle, and then it went up, and then surprise, surprise, it hit the zone and fell. So the real issue with this one, even though if you look, it's interesting, it does have space. It's the largest candle we've seen in the last 6, completely engulfs the prior candle. It's got plenty of space here until you run into these candles over here. The real issue with this candle is that it isn't on a support zone, which is what you really want to see. These bullish ones, you want to see them on support. So on the upside, on the top side, above the zone, really. And then the next candle didn't really trigger it, but that's okay because the second candle did. So this would not be what I would call a good setup. Yeah, not ideal. Okay. All right, let's switch to another one. We'll go on to our next swing pattern. And I think we had Kiwi, Aussie, and Pound Yen. So we'll go to the next naked Forex pattern, which in this case, this is the, okay, I'll show you a, okay. I'll show you, I can show you a couple of failed ones. I can show you a couple of failed ones, really. Actually, maybe what I can do is show you a good one, and then we'll look at the failed ones after, and we'll see if we can pick out why. All right. So again, on the Kiwi here, what I'm going to do is just delete all of the objects off the chart, okay? And I'm going to go weekly, and I'm going to go line chart. And then what you'll see here on my chart is you'll see all of my support and resistance zones here. So I'm going to put it at the swing. So that if there's a swing high and a swing low, there doesn't have to be obviously touches on both sides. But most of my zones here will have touches from above, so support, and touches from below, which is resistance, obviously. But in this case, you have a swing low down here and a swing high where we don't necessarily expect touches on both sides because they're extreme highs and extreme lows. Now, if we go back far enough on the chart, maybe we would see that, but I'm not going to do that right now. I just want to position all of these zones on the chart for you. So we have all of the spots taken care of. There's going to be one in here too, probably in there. Looks like there's going to be one in that area too. And one in this area too. Sweet. All right. Okay. So do you see why I did that? If I'm going to trade the Kiwi daily chart, then obviously I go to the Kiwi weekly, throw on the line chart, draw all of the zones in where the squiggly bounces are. And obviously I'm looking for squiggly bounces from below the zone where there's resistance right here, and then support like we see over here, right? We want support and resistance, and that's going to define it for me. Now you might say, hey, Walter, what the heck? You've got like, what's going on over here? How come this is a zone and the market went through it? Well, number one, I'd say we probably wouldn't have a pattern here, a naked Forex pattern. And two, even if we don't have a pattern, oftentimes what you'll see, totally be wrong here, but we're gonna find out in a minute, is sometimes what you'll notice is that it actually pauses before it breaks through. So it doesn't throw up a reversal signal, and in fact, it actually pauses before it does eventually break through. So let's have a look and see if that's the case here. Okay, so I'm going to back this up and see if we can find that spot that I had identified on the chart. And indeed, you can see that it did bounce and then hold and then finally broke through. I'll zoom in so everyone can see. I know sometimes it's difficult to see here. Do you see what I'm talking about? So it actually respected the, even though, remember, on the weekly chart, it was almost like a straight line that went straight through. You didn't see anything. It didn't look like it was respected at all. And it's like, well, what's going on here? Well, actually, it bounced, pulled back, hit it again, held for a couple days, and then finally it broke. Okay. All right. So now let's look at the next pattern that we're looking for here. I want to show you another one. And this one is an example. Okay. All right. So we're going to talk about this one. This is a great example, actually, because we are going to see a couple of interesting things about this. Now, this is the kangaroo tail. Now, some people say, well, hang on. Kangaroo tail, what's the difference? It's a pin bar, right? Pinocchio bar from Martin Pring. Actually, no. I don't think so. I think a kangaroo actually has a few different criteria that you don't see on when people talk about pin bars. So kangaroo tail, I got that from Alexander Elder in his book, Come Into My Trading Room. That's the first time I saw this idea, and I go, wow, it actually blew my mind, because I was looking at things like stochastics and RSI and MACD, and then when he was talking about kangaroo tail, I was like, that's brilliant. Okay. So this is what happened, okay? What we have here is we have a candle where the open and the close, again, we're going to use the bearish example, the open and the close are in the bottom third of the candle. Okay, that's very important. And I'll give you an optimizer too in a moment. So open, close, in bottom third. That's number one. And you can see that's the case here. Now, there's an easy way to check. If you've got MetaTrader or another charting software that allows you to draw fibs, oftentimes what you can do is you can actually draw a fib across the candle from high to low, from the wick to the head, and you can see you can set it at 33%, which is what I do. I actually set a 30, which is not, of course, not a fib ratio at all. But here, I'll edit this for you. So if I delete 161, 261, 361. What you'll notice is that, oops, I didn't do it right. I made it too big. There you go. What you'll notice is that that 33% level is slightly above the open. So the open on this kangaroo tail is below the 33% level, and the close is obviously below the 33% level because it's a bearish candle body. So this would satisfy the first criteria, which is the open and the close on the bottom third of the candle. Number two, and again, you can even be more stringent than that, but we'll talk about that in a minute. Next thing is that there's space to the left, or room to the left. But as we were talking about the two candle formation, which is the bullish and bearish big shadow, if you have room to the left, the easiest way to see that graphically is to pull across some of the candle that is printed in a unique area of the chart, and it comes all the way over to here. In fact, some of that candle even goes further across here and all the way off the chart, okay? But the majority of that candle comes up and hits here. And that's, what was that? It was another time when the market hit that zone and reversed, okay? So it's got room to left, it's got space, it's definitely in the bottom third. So we know that's, that's really good. Now, I will say something and this takes some time to get used to. Some people don't really, they don't really see this. Like it's not easy for them to see this after a while. It takes some time. But one thing that I will say is that it's important for you to understand that when you're trading kangaroo tails, you want the tail on one side of the zone and the head on the other. And the reason why this is the case, and again, the easiest way for you to see this is just to back test it for yourself. The easiest way to say this is that because we don't want to take a breakout and a retouch. Okay, so if you think about it, if we could just take this candle, lift it up, and move it on the other side of this zone, then what we would say is that it actually broke through this 70 to 63 zone. It traded higher. It came back down and confirmed that, and that created the kangaroo tail. So if the head of this kangaroo tail, which is the body, which is the red part of this candle, if that were on top of this zone and above this zone, and the entire candle was above it, then you could say that perhaps what we're looking at here is not a reversal at all, but just a breakout, a simple breakout and retouch, in which case we're going to get blasted, we're going to get stopped out, right? Okay, so hopefully that makes sense. But the best way for you to get this idea is to test it for yourself. Run through Forex Tester or go through your MetaTrader charts, press the F12 key to advance one candle at a time, and you can see this all on your lonesome. Okay, number 3 is that the open and close are inside previous candle. Okay? So the open and the close are inside the previous candle. What do I mean by that? Well, not only do the open and the close need to be in the bottom third for a bearish kangaroo tail, but the open and the close also need to be inside the previous candle's range. So from the low to the high of the previous candle, that would make this a valid kangaroo tail. Why do we use that rule? Because we don't want to be catching a falling knife, okay? And if you get a kangaroo tail where the candle is completely, the open and the close are not inside the previous candle, it means that's a fast-moving market. There's not a lot of overlap between candles, and it's quite likely that it's just a normal pullback in the midst of a trend. So that's why that's a pretty good rule to follow. If there are any questions about these rules, let me know. I'm going to keep going, but if you guys have any questions, just post them in here. Okay. Next is that I'll take, for a bearish kangaroo tail, I'll take a sell on a breach of the candle low. It's a simple sell stop order on a breach of the candle low, which is really, really, really easy to do. So let me just set this up for you. Let's say that you've got a job and you're away from your trading station at home from 7:30 in the morning till 7:30 at night. You've got 12 hours that you can't trade, right? Because you're at work. Or maybe you can trade if you get on your phone and you go to the toilets or something like that. I know some traders that do that. But let's say that, and beyond that, you're tired, right? You got other things going on. Maybe you have a wife, some kids, or girlfriend, boyfriend, whatever. You got a lot going on. So you don't necessarily have time to sit down and, pound out some trades on the 5-minute charts for 5 or 6 hours after work. That's the quick way to burn out. So what you can do is you can use these swing patterns that we're talking about, these naked patterns today that we're talking about, and you can apply those simply to the daily and weekly charts, or the 8-hour charts, 12-hour charts, whatever. It's really, really simple to do that. Like, extremely simple. So I would encourage you to test these to see if they work for you. The open and close in the bottom third of the candle, there's room to the left. The open and close are inside the previous candle's range, and then you put a sell stop below the low. Again, the stop loss goes above the high. The sell stop goes a few pips below the low. So in the case of this daily Kiwi candle, we'd be looking at, about 160 pips of risk. Where might you take profit? You could take it at the next zone. The problem with the next zone is only 60 pips away. So we go to the next zone. So we're looking at 260. So you've got 170 pips or 160 pips of risk and 260, 270 pips of reward. Okay. So it's better than 1-to-1. It's about 1.7 to 1 or whatever. But that would be a very simple trade. Now you can see this one got stopped out, right? It didn't work, but this is exactly the kind of trade I would take. I would take this every single time. Even though this trade got stopped out, I would take it over and over again because they have a pretty high win rate. I'm talking 65, 70% is what I see. And for the big shadows, you can go 70 to 80%. So it's a little bit higher win rate than the kangaroo tail. Now, a couple of things to watch out for. See this candle right here? I'm going to draw another one. This one right here is tricky. The white one, I'm going to color this arrow blue. And that one's tricky because the close is not inside the previous candle's range, and the tail doesn't extend through the zone. Remember what I said? We really want to see candles where the tail goes beyond the zone, but the head stays on the right side of the zone. Since this is a bearish setup, you still want to see the head, and you want to see the tail extend through. Why do you want to see it extend through? Because you want to clear out the stop losses that are over here from the last time it got up here, which is really why you have that tail. It's clearing out all those guys who sold over here. Okay. All right. Now, another thing that I want to talk about is optimizers. And I promised you that I would, so I'll quickly go over this. Some people get enamored with these little tiny kangaroo tails because they can have a really tight stop. I found that they don't work as well. I found that they have a lower win rate, and I'll take the longer tailed candle every day of the week. Now, maybe in another webinar, we can talk about other ways that you can get in, where you can get in with less risk in terms of pips, and better reward to risk ratio, but you're always going to sacrifice your win rate when you do that. So you can take these and you can go for these. And in this case, this one gets to the other side of the zone, and that's fine. But a lot of times you won't see that happen. And I found them to be less reliable. So, okay, cool. All right. Now, hopefully that makes sense. Cool. Let's keep going, because what I want to do is I want to show you another one. I think the other pound yen was the other one that we were looking at, right? Okay, pound yen. Okay, so look at that head and shoulders. Does everyone see that? Shoulder, head, shoulder. It's come back up, and it looks like it's breached the neckline. So unless we completely engulf yesterday's candle with a big bearish candle, that's kind of a big fail, isn't it? All right, let me show you something. There's another one that I want to show you, and it's a little bit, can be a little bit trickier to see. But this is what this pattern looks like. It's a special case of a double bottom or a double top. So in this case, this is the pound yen daily chart. You can see that it's come down here, and it touched the zone here, down here. All right. Now, I don't know that this is a zone. I don't know that I would have drawn it on the weekly, but yep, it's pretty good. Actually, it is a pretty good zone. Okay. So I just drew it because I wanted to show you the rules of this. This is what we call a whammy bottom. So obviously, as you can reverse the rules that I gave you for the kangaroo tail, you can also reverse those. If you wanted to take a bullish kangaroo tail, you would reverse the rules that I gave you. So the open and close in the top third of the candle. And by the way, a maximizer for that would be to have an open and the close in the top 10% for a bullish kangaroo tail, or the open and the close in the bottom 10%. So if you had a 100 pip candle, then the open and the close would have to be in the top 10 pips, right? Or the bottom 10 pips. Okay, and then with this is a special case of a double bottom where the market has been falling, hits support, comes up, comes back down, hits it again, but it makes a higher bounce. See how the low over on this candle was actually at 180.23, whereas the low over here was at 180.65. So that made a higher low. And then once the market starts pulling, going with bullish candles here, probably the most bullish candle would be this one or this one. I would put an order above the high, and the stop loss goes all the way down below the previous candle low. Okay, so the stop loss goes here because it's lower, and you want to give it a chance to pull back again, which it did right here, and not stop you out. So in this case, the risk would be essentially about 350 pips. Remember, we're talking about the pound yen here. It's quite volatile. So if you wanted to go for 350 pips, you could go for this area here, which is a pretty good target, and it did reach it over here, right? You could also go for this target over here, which is about 800 pips, and it didn't reach it. It only got to here before coming back down. But if you did get up to this level, you can take some profit and then go break even, right? And then you get stopped out over here and break even, basically. Does that make sense? Now, to take the bearish one, the bearish reversal, so that's a whammy. The bearish one is a moolah top, and it's a very similar setup. It's kind of the same thing. You have the market comes up, touches the zone, pulls back, comes back up, doesn't go as high like this one right here. So here's a first touch, here's your second touch. This one's a little bit gappy. It's a bit further away, but you can take these. I like them, actually, in fact. And you can see here, see how this candle was quite bearish, and as soon as it traded lower on the second candle, that would be your trigger. So the risk on this one would be roughly 522 pips, and 522 pips would put you probably down here. Yeah, you'd be looking for probably this area here. That would give you about 600 pips if you look for these highs right here, and it does in fact land on them over here, right? Now the next level might be down here. That's about 1,000 or 1,100 pips, and it doesn't quite get down there to that one. Yeah. So there you go. Now, are there any other charts that you guys would like to see? If you want to see any live charts, I'm happy to take some questions on the live charts if we have some time. But otherwise, I wanted to just make sure that we covered those three. So that's the big shadow, which is a special case of the engulfing candle, kangaroo tail, which of course those rules and those optimizer rules are going to help you if you use like the 10% rule, and then the special case of the double top, double bottom whammy / moolah. So there you go. Let me know if you have any charts you want to see. I can tell you the trades that I'm in, right? Well, actually, so the trades that I've taken, okay. Well, basically, I had another, the trade that I took this week was a bearish big shadow, which was this one right here, okay? And it was, see how it breached support here or breached resistance? This pattern here, when you get a trend line in a horizontal level, this is a different one altogether. And usually you will see it squirt higher. In this case though, however, it in fact didn't squirt higher. It gave me this engulfing candle, and I got in on this candle right here. Pulled back and then fell. And then yesterday when this candle was printing, this is the Aussie 4-hour chart, I moved to break even, then it came back up and stopped me out at break even. So that one didn't quite work out. There's another one I'm in right now that's the pound. And I'll show you. This is a buy actually off this little bounce right here. And I had identified this as another possible level for bounce. I wasn't awake. I didn't see it when this happened, but I actually drew this zone in before it did that. So I drew the zone in when these candles were printing over here. I said, look, it might come down here and bounce, and it did. It gave us a really nice bounce. That's not a bullish big shadow, but it's a nice bounce. And then yesterday I was waiting for a pullback and another strong move up. So this one, this is like 32 pips of risk or something like that. And at the present, it's up 165 pips. So that's a really good reward to risk ratio. These sorts of trades, we're going to talk about these trades next week on Tuesday. So if you guys come to the next webinar on Tuesday, you'll see we're going to talk specifically about this style of setup. It's like pretty much my favorite way to trade right now. But the reason why I'm pointing out the pound is because the pound's in a strong uptrend, and I would look for any sort of reason to go long the pound, basically. Quite bullish the pound, yeah. So any reason to go long the pound is fine by me. All right. Okay, guys. Thanks so much for your time. I hope that you have a wonderful trading week, and hope to see you next Tuesday. I believe that is 10 a.m. GMT time, when we're going to talk about these trendy entries that are really good for a huge reward to risk ratio, like the one I took yesterday on the pound. These are pretty much like my favorite trades right now. The most difficult thing is just finding the right markets to take them on, because you really do have to take a trending market, otherwise you get blasted. So you got to get in on the strong trends, basically. See you next Tuesday, 10 GMT. Take care, guys. Bye. Take care. Thanks. Bye.